Hi, I am Anna. I come from www.ntvforex.com. September flashlight for the FOMC blackout period analysis. http ntvforex.com news ID 72368898 2021 19:24 p.m. Executive summary. The most significant change to U.S. monetary policy over the past few months occurred not at a regularly scheduled FOMC meeting, but rather at the Kansas City Fed's annual Jackson Hole Symposium, which was held virtually this year. During a speech for the symposium on August 27, Federal Reserve Chair Jerome Powell announced that the FOMC would adopt a flexible average inflation targeting regime. Going forward, the committee will aim to achieve inflation that averages 2% over time. Powell also revealed that the FOMC will take a more dovish view of labor market developments, stating that monetary decisions will be informed by assessments of the shortfalls of employment from its maximum level rather than deviations from its maximum level. The upcoming FOMC meeting, to conclude on September 16, will be the first official meeting since these announced changes and will afford Powell the opportunity to further expand upon these major changes to the Fed's operating framework. The upcoming FOMC meeting will contain more than just additional information about average inflation targeting. The September meeting will include the first update to the Fed funds dots and summary of economic projections (SEP) since June, as well as the initial rollout of 2023 forecasts from FOMC participants. We expect the vast majority of participants will indicate that a Fed funds rate between 0.000.25% will still be appropriate in 2023 given the new framework. Another key topic will likely be whether the committee has moved any closer towards explicitly tying future rate hikes with time or objective-based metrics, such as the unemployment rate or inflation. Our sense is that the FOMC is in no rush to tie its hands in this way, but deliberations are likely to continue on the topic at the September meeting. With the Fed funds rate likely anchored at zero for several years to come, short and intermediate-term Treasury yields should remain stuck near current levels. Past the 5-Y point, we see moderately higher inflation as a possible catalyst for higher yields. Average inflation targeting what's the deal? The Federal Reserve has long conducted monetary policy with the goal of satisfying its dual mandate of price stability and maximum employment. In terms of the inflation half of that mandate, the FOMC has held that 2.0% is the inflation target best suited to achieving price stability. After years of inflation coming in below that target, the Fed recently underwent a review of the various policy tools used to achieve its mandates. One of the major outcomes of that review announced at the Jackson Hole Symposium was the Fed's embrace of average inflation targeting. The FOMC voted unanimously to embrace this new approach. So what exactly is average inflation targeting, and how does it change things? Anchors away. Financial markets are good at identifying and pricing variable outcomes. When it comes to inflation, monetary policymakers, not just at the Federal Reserve but also many foreign central banks, wrestle with the fact that inflation expectations become anchored to a particular rate. John Williams, the president of the Federal Reserve Bank of New York, has framed the issue as a pricing in of the complete business cycle. He cites an example of an economy in the expansion phase of the business cycle about 80% of the time and in recession the other 20% of the time. His point is that during the expansions, the Federal Reserve generally does an adequate job of keeping inflation around 2.0%, but during recessions, inflation often comes in closer to 1.0%. In Williams' own words, the resulting average rate of inflation is about 1.8%. As a consequence, inflation expectations are likely to become anchored at the long-run average of 1.8%, below the desired 2.0% target. 1. In our view, Williams' way of thinking makes the most pragmatic case for the need to allow inflation to overshoot a bit during economic expansions, such that long-term inflation expectations become anchored to the appropriate target. To some extent, the Federal Reserve has already implicitly done this, though in prior periods Fed officials would go through linguistic exercises when it allowed above-target inflation, assuring markets that it was looking through a temporary driver or that higher inflation was transitory. The more formal embrace of this new tolerance for above-target inflation plants the seeds for a new era of policymaking. If the Fed is indeed able to anchor inflation expectations at 2.0%, it would lift nominal interest rates during expansions and effectively give the Fed more ammunition via rate cuts the next time a recession comes along. A later curfew. To the extent that we are really in a new era, one of the questions financial markets will want to explore is just how much of an inflation overshoot the FOMC will allow without signaling a less accommodative policy path. In the past, a classic metaphor has been that the Fed takes away the punch bowl before the party gets too raucous. The interpretation of that metaphor for this era is the following: there is a later curfew, but rather than get a clear delineation of exactly when it is, there will just be some testing of how late is too late without pushing it too far. There were no immediate answers to these questions at Jackson Hole, and we do not expect to get much clarification at the September 16 meeting either. The Fed is being deliberately vague about the extent of the inflation overshoot it will tolerate, which is why Chair Powell deliberately referred to the new program as a flexible form of average inflation targeting. Although we do not anticipate inflation climbing above 2.0% on an ongoing basis in the next couple of years, eventually it could, which will afford the opportunity for some price discovery around the Fed's tolerance range. When pressed on this in an interview during the Jackson Hole Symposium, St. Louis Fed President James Bullard said, "I don't think you want to get into precise mathematical formulas here. But the spirit of this is that, in the committee's judgment, it would be wise to allow inflation to be above target for some time to make up for past misses. That is the essence and spirit of average inflation targeting in a nutshell. I used to hurry a lot, I used to worry a lot. The new summary of economic projections SEP will be the clearest signal yet that the FOMC will be slower to raise rates under its new policy framework. Near-term changes to the SEP should be inconsequential. The virus continues to impart a tremendous amount of uncertainty to the economic outlook, making it unwise to read too much into tweaks to the SEP over the next year or so. Moreover, the outlook has not fundamentally changed. Most observers still expect the economy to operate at a significantly reduced capacity over the next year or two, which should be borne out in the 2020 and 2021 projections for GDP growth, the unemployment rate and inflation. Beyond 2021, however, the SEP should more clearly illustrate the Fed's new reaction function. The new framework should push out the timing of rate hikes as the committee seeks to see inflation run somewhat above 2% for a time, rather than merely return to 2%. Given that the adoption of the new approach was unanimous, we would anticipate that all FOMC members now expect rates to remain on hold through 2022 versus two members who in June projected at least one rate hike in 2022, a figure 1. After all, the top end of core inflation projections in June registered 2.2%, which we see as consistent with price growth only modestly above 2%. Download the full special commentary. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.